Takeaway number 1. Investment versus speculation. What's the difference between an investor and a speculator? Is it that the former wears a tie and is working in some fancy office at some fancy street in cities like New York, London or Stockholm, and that the latter is gambling with his mortgage at the casino? Nah, I think we need a more useful definition than that. Distinguishing between investing and speculation lies at the very heart of security analysis, because it's absolutely essential for the sake of your portfolio returns to understand which one you are engaged in. As a matter of fact, Benjamin Graham would call most of the aforementioned tie-wearing Wall Streeters speculators. It's just that they cover their gambling really well with speculation in stocks of strong companies. Here's what Benjamin Graham and David Dodd says. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. This quote probably raises more questions than it gives answers, so let's break it down. By thorough analysis, Benjamin Graham refers to the importance of a careful study of available facts, with the attempt to draw conclusions from that with sound logic and based on established principles. For instance, buying Netflix at a price of 140 times its highest reported yearly earnings is speculation, not investment, as the valuation clearly relies on expectations about the future, rather than available facts. Safety in the security markets is never achievable under all circumstances, but the investor must protect himself under all normal or reasonably likely conditions. Benjamin Graham is famous for coining the expression margin of safety, which allows for protection by insisting that the value of a security should be bought only when it can be obtained with a margin to the price. For example, buying Apple at $210 per share, if you think that it's actually worth $220 per share, would be considered speculation. You should always factor in the possibility of being wrong in your analysis. But more on this in The Intelligent Investor. A satisfactory return is truly subjective. Any return that the investor is willing to accept will actually do here, as long as he acts with some kind of intelligence. If it's possible to acquire US Treasury bills at a 5% annual return, but for some reason he decides to invest his money in a microcap mining stock at an expected 4% return, it would fail to be regarded as an investment operation, even if he has safety and a thorough analysis in place. In summary, or perhaps in addition, an investment operation is one that can be justified based on both quantitative and qualitative grounds. But more on this in takeaway number 3. Going back to the previously mentioned Netflix case, this does not mean that the analyst is convinced that the market valuation of Netflix is wrong, but rather that he is not convinced that its valuation is right. He would call a substantial part of the price a speculative component, in the sense that it is paid not for demonstrated, but for expected results. Benjamin Graham provides an excellent chart of how the price of a security is determined and points out which components that may be regarded as investment and which that are speculative. In the case of Netflix, a great portion of the current market cap of almost $170 billion is made up of the market factors, which are 100% speculative, and the future value factors, which are part speculative and part investment. Only a small portion is made up of true investment value, which Benjamin Graham refers to as the intrinsic value factors. Takeaway number 2. Classification of securities. So, we now have a brief understanding of what the difference between an investment and a speculation is. We are going to focus on the former in this series. There are many different types of securities that could qualify for investment purposes though, and we will now outline them briefly. The traditional classification is bonds, preferred stocks, and common stocks. Bonds have an unqualified right to fixed interest payments, an unqualified right to the repayment of the loan or principal amount, but no other participation rights in neither assets nor profits. A preferred stock, despite its name, is more like a bond than a stock. It has a stated dividend, but nothing must be paid if the common stock doesn't receive anything either. It has the right to its principal if the company goes bankrupt and gets money before any common stockholder. Like the bond, it doesn't participate in any excess profits made by the company. The common stock has the right to all assets and profits in excess of everything paid to bond and preferred stockholders. This class of security is what people typically refer to when they talk about stocks. Because common stocks basically aren't promised anything, many mistakenly think that stocks are always speculative and that bonds are always investments. This is not true. A bondholder is promised that he'll be repaid, but that promise is only as good as the financial position of the company that's making it. Rather than organizing securities according with their titles, Benjamin Graham suggests that securities should be organized based on their normal behavior after purchase. Why? Because then the categories can be treated similarly from an investment perspective. The suggestion is: the first category is made up of securities of the fixed value type. It consists of high-grade bonds and preferred stocks, and the assumption is that you, more or less, should be able to forget about these and collect the interest payments. The second category is made up of senior securities of variable value. It's divided in two parts: issues of high grade, but that at the same time have profit possibilities, such as convertible bonds, and issues of inadequate quality, such as low-grade bonds and preferred stocks. The last category is common stocks. We'll examine these categories in greater detail in the third and fourth video of this series. Takeaway number 3: quantitative analysis versus qualitative analysis. In takeaway number 1, we learn that an investment operation must be able to be justified both on quantitative and qualitative grounds. We're now going to decipher what that means in practice. An analysis should be thorough for it to be considered an investment operation. The issue is that already in Graham's days, the supply of information of a single security was typically more than an analyst could plow through. And Graham only lived to see the very beginning of the information age. The supply of information has increased exponentially during the last decades. Needless to say, an investor can only consume so much of it. The depth of his analysis should therefore depend on his invested amount, as that is a good indicator of how much value additional analysis can add. If Warren Buffett can increase his yearly returns by 1%, that would mean about $800 million more in income that year. If the average Swede can increase his return by the same percentage, he will only increase his income by approximately $1,900. Depending on how much time he must invest to achieve that extra return, it may or may not be time well spent. Information is of two types: quantitative and qualitative. Quantitative data may be divided into capitalization, earnings and dividends, assets and liabilities, and operating statistics. And qualitative information are things such as quality of management, customer preferences and trends, competitive landscape, and technological change. This book is heavily tilted towards the quantitative data. After all, it's called value investing. And Benjamin Graham states that the former are fewer in numbers, more easily obtainable, and much better suited to the forming of definite and dependable conclusions. Moreover, quantitative data typically reveals a lot about the qualitative factors as well. Is the management competent? Well, have the earnings, assets, and dividends of the company increased under their lead? In that case, yes, very competent. With that said, quantitative data are useful only to the extent that they are supported by the qualitative survey of the enterprise. The intelligent investor should insist on having both a quantitative and a qualitative validation of his investments. Takeaway number 4. Obstacles for the analyst. There are 3 primary obstacles that makes successful security analysis more difficult than it might seem at a first glance. These are inadequate or incorrect data, uncertainties of the future, and irrational behavior of the markets. We will discuss the first point in much greater detail in the second video when we dive into the 2 major financial statements of a company, the income statement and the balance sheet. For now, it will be sufficient to say that data in company reports may not always present the situation in a useful manner to the investor. In general, when you suspect that you've encountered a company that pursues questionable accounting principles, avoid all securities of that company. You cannot make a quantitative deduction to allow for an unscrupulous management. The only way to deal with such situations is to avoid them. Have a look at this list of companies. What do you think the common denominator is? If you said, they were all Fortune 500 companies back in 1955, but are no longer on the list. Well done. As a matter of fact, in 2014, 88% of companies on the Fortune 500 list from 1955 had been replaced, either by going out of business, being surpassed by new companies, or by being acquired by other major players. These were some of the companies with the greatest profit margins, the greatest earning trends, with the best financial positions. But in investing, the future is often no respecter of statistical data. Even if the investor concludes that there's a discrepancy between the true, so-called intrinsic value of a security and its price, the market may not realize its mistake. And after holding on to that same security for years, during which the market remains irrational, the investor may have to witness how his original thesis no longer holds true, whereupon he will have to sell that security off with a loss. Takeaway number 5. Investing is the search for exceptional cases. So, investing seems like it's quite tough. Is it even so that the factors mentioned in the previous takeaway nullifies any effort of the analyst? The answer is yes, in most cases, but not all. The intelligent investor will have to analyze a whole bunch of companies. In most cases, he will conclude that its securities can't be bought with the aforementioned margin of safety and at the same time yield a satisfactory return. But eventually, he will find investments where both are obtainable. Security analysis isn't an exact science. You should only act in exceptional cases. Benjamin Graham gives a great example of this in the common stock of Wright Aeronautical that was priced at $8 per share back in 1922, when it had, for some time, been earning $2 per share and had more than $8 per share in cash only. It would have been difficult at this point to decide whether Wright Aeronautical was worth $20 or perhaps even $40. But luckily, that wasn't necessary to conclude that it was attractive to buy the stock at $8. It's easy to see that a man is heavier than he should be without knowing his exact weight. Because of this, the buyer of securities shouldn't be interested in exactitudes, but rather in reasonable accuracy. After all, the analyst is dealing with data representing the past, which, as we've discussed already, isn't always respected by the future. Here's a quick summary. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. There are many different types of securities suitable for investment operations. They are, however, not bought under the same premises. Quantitative data must always be validated by qualitative observations. The incorrectness of data, uncertainties of the future, and irrationalities of markets complicate the work of the analyst, but they do not nullify it. One of the greatest advantages of the analyst is that he can, and should, only act in exceptional cases. In the next video, I will present the most important aspects of analyzing an income statement and a balance sheet. After that, I will present the ins and outs of common stock investment, and lastly, that of senior securities. Cheers! In the last video in this mini-series of security analysis, I gave a brief introduction on the subject of analyzing securities in the markets. Among other things, the difference between an investment and a speculation was explained. And if you haven't watched that video yet, I strongly suggest you do before watching this. For this video, we are going to talk income statements and balance sheets. I'll explain why they are important to consider and what to look for, not as an accountant, but as an investor. If you're completely unfamiliar with these two financial statements, I suggest that you watch this video before continuing here. Now, let's dive into the second part of Benjamin Graham's masterpiece.
Say after me, please. Benjamin Graham.
Benjamin Graham.
One more time. Benjamin Graham.
Benjamin Graham.
Benjamin Graham.
Benjamin Graham.
Benjamin
Benjamin
Graham.
Graham.
No. Graham.
Graham. Takeaway number 1. Analyzing the income statement. Let's start out with the income account. This reveals the historical earnings of a company, which, in turn, is a good indicator of how much investors have received during the same period. The study of this statement goes under 3 separate headings. The accounting aspect. What are the true earnings of the past? The business aspect. What does this indicate for the future? And the investment aspect. Based on this indication, what is a reasonable valuation of the security? In the previous video, I stated that data in company reports may not always present the situation in a useful manner to the investor. Now, allow me to present an absurd hypothetical example to show you why. Imagine that you have the possibility to invest in one of 3 different YouTubers. YouTuber A, B, and C. They produce videos in the same niche. All of them have the same revenue, say $500 per year, which they generate from ads, and they all have 100 shares outstanding. They all bought computers for their companies during their first year of business. YouTuber A paid $2,500 for his, while B and C paid $1,250 for theirs. A and B decides to depreciate, or in other words, write down the value of their computers over 5 years. C, on the other hand, decides to write off the whole stated value in the balance sheet in just 1 year. 2 years later, you decide that you want to invest in one of these businesses. At a first glance, when you observe the earnings of year 2, it may seem like company A earned nothing at all. B earned $2.5 per share, and C earned $5 per share. When the novice investor sees this, he's not willing to pay much for a share in company A, perhaps just a speculative $2, hoping that the profit margins will increase soon. For B and C, on the other hand, he might be willing to pay for example, 10 times the annual earnings, or in other words, $25 and $50 per share, respectively. Someone with the interest of buying the whole businesses would realize how absurd this is. Really? Paying 25 times more for a similar company that generates the same amount of cash? Nah. Besides, Company A has assets at a total value of $2,500, while C has, realistically, not according to the books, assets at a value of $1,750. So there's even an argument to pay more for Company A than for C. Even if this example is a bit extreme, I hope that you get the point. Earnings play a major role in deciding the valuation of companies, and yet sometimes they reveal so little about how the business is truly doing. You need to be able to adjust the earnings yourself so that they give a fairer representation of the past. And for this, we need to learn about some of the common ways that companies distort their performances. And unfortunately, they are typically disguised better than in this hypothetical example that I just showed. Takeaway number 2. 6 common ways to misrepresent earnings. In deciding what the true earnings of the past are, we want to understand what Benjamin Graham calls the company's earnings power. This can be considered as the ordinary operating earnings of the business. But the analyst must remember that even after adjustments, he will only get a more nearly correct version of the past. Correcting the income statement is done through a via negativa approach, as Nassim Taleb would call it. We remove what's wrong and then we get something that is correct. Well, nearly correct at least. Here are 6 common ways to confuse investors. Accelerating depreciation. Here's how depreciation works in theory. If a capital asset has a limited life, provision must be made to write off the cost of the asset by charges against earnings, distributed over the period of its life. But, in practice, companies don't always follow this. Sometimes, they decide to write these assets off faster than the lifetime of the asset suggests, such as YouTuber C did in our previous takeaway. This will make it so that the earnings in the following years will appear greater than they really are. Beware. Decelerating depreciation. At other times, depreciation happens too slowly. If YouTuber A, for example, would have used a straight line depreciation of 10 years for his computer instead of 5, it would have appeared as if he had earned $250 more in every year. But obviously, the earnings power of his company wouldn't have been $250 stronger, and neither would it have been worth more to an investor, just because he used another method of accounting. Allocating expenses to the balance sheet instead of the income statement. Companies sometimes capitalize normal operating costs, which means that they reduce their expenses in the income statement by moving them to the balance sheet, building up long-term assets. Thus, income statement earnings are increased. The YouTuber is in a very interesting situation here. If he creates content that can be consumed over many years, should expenses associated with his video making be considered operating expenses or capital expenses? Pretending that everything is extraordinary. Extraordinary expenses should typically be removed, and thus increasing the numbers when calculating the true earnings power of a company. But, as you probably have guessed already, some companies are sneaky here. Let's say that the YouTuber bought some merch that didn't do very well. He'll have to write down the value of the merch on his balance sheet, which will affect earnings negatively. But if he decides to call this expense extraordinary, the normal investor will typically overlook this in his valuation of the business. Recording revenues prematurely. Even though all services in a contract haven't been fulfilled yet, all earnings may be recorded in the current period. Let's say that the YouTuber has a partnership with another channel, where he's supposed to create a new series. He's paid when the full series is done. At the end of the first year, he might have completed, say, half the series, but decides to record the full contractual revenue in the current year anyways, moving current expenses to the next year, or the year after that. The height of hypocrisy is reached if a company records its earnings prematurely, but then takes the exact opposite stance when it comes to expenses. Let's say a YouTuber wants to set up a website for his channel and hires a programmer to do so. Maybe the website is up and running, but there's still an ongoing contract for updates and maintenance after the first year. The investor will want to see the expenses accumulated so far in the income statement, but the books may fail to show this, as future services still remain. If you are uncertain, always compare to competitors within the same industry, something which we'll discuss in the next video. And also, when doing these adjustments, always remember that security analysis is a severely practical activity, and it must not linger over matters that are not likely to affect the ultimate judgment. Takeaway number 3. What does this indicate for the future? Alright, so we've kind of answered the first question. What are the true earnings of the past? Now for the second one. What does this indicate for the future? Let's consider two different types of hypothetical earning records. Which one do you think provides a better guide for the future? Obviously, it is A. We've said in the last video that the future is no respecter of the past, and this still holds true. But past earnings give a rough indication, and you can trust in this indication more if the earnings record is longer, an average is used, it includes whole market cycles, the business is stable. Follow-up question. How do you think the earnings of these two companies will develop in the next 5 years? It is truly tempting to just project the earnings trend of the past into the future. According to Benjamin Graham, one must be very cautious when doing this though. Investment value can be related only to demonstrated performance. Competition, regulation, the law of diminishing returns, etc. are powerful foes to unlimited expansion, and in smaller degree, opposite elements may operate to check a continued decline. Or in other words, neither abnormally good nor abnormally bad conditions for a business lasts forever. In the third and the fourth video, we'll answer the third question. What is a reasonable valuation of the security? Takeaway number 4. Analyzing the balance sheet. We've now arrived at the other important financial statement that existed during Benjamin Graham's time as an investor, the balance sheet. Instead of using only earnings from the income statement as a basis for your investment, which, as we've seen, are both fluctuating and the subject of misleading representation, why not use a twofold test? Going back to takeaway number 1, surely you would like to acquire the YouTuber with the more valuable asset, everything else equal. I mean, in case he decides to stop putting up these YouTube videos and leaves the company, you can at the very least sell his computer on eBay and get some of your money back, limiting the downside. The usual purpose of analysis of the balance sheet is to weed out weak companies. For example, you can identify if the company has liquidity issues by looking at the current ratio and insisting that it's greater than 2. Problems paying interest charges by looking at the interest coverage ratio. More on this in video number 4 though. Too much or perhaps too little debt. More on this in the next takeaway. Or problems with sales by looking at the inventory levels and how they have changed over time. Don't overlook the balance sheet. Assets and liabilities surely aren't as sexy as revenues and profits, but they are just as important for the intelligent investor, and more dependable. Takeaway number 5. The importance of capitalization structure. A central part of the balance sheet is that of how the company has been financed, often part equity and part liabilities, sometimes issued as bonds. This is referred to as the capitalization structure of a company. Let's return to the 3 YouTubers. Neglect their computers, but remember that they earned $500 per year. Company A is capitalized solely by equity. Company B has a mixture of common stock and $2,000 in bonds at a 5% interest rate, while Company C has common stock and $6,000 in bonds, also at 5%. After deducting the interest expenses from the revenues of each of these companies, they earn the following amounts per year. Let's again assume that their common stock is valued at a PE of 10, and therefore the total value of the common stock of the companies should be as follows. Adding the value of the bonds to reach a total valuation for each company, we notice something interesting. The total value of Company B is $1,000, or 20%, higher than that of A, and the enterprise value of C is even $3,000 higher, or 60%. How can it be that companies with the same earnings power are valued so differently, based solely on capitalization? Can it? To answer this question, we must understand whether it's reasonable to value the common stock at a PE of 10 and the bonds at the so-called par value in each of these cases. Let's compare Company B to Company A. There's no reason to believe that the bonds of Company B would be priced lower than par. The company is earning 5 times its interest expenses, which provides a margin of safety. More on this in the 4th video. Sure, the common stockholders of Company B are more vulnerable to shrinkage in revenues than Company A, but this is offset by the leverage that they have compared to shareholders of Company A in the case of an increase. Paradoxical as this may seem, we must thus accept that Company B is worth $6,000, or 20% more than A, merely because of its capitalization structure. Benjamin Graham states the following as a rule of thumb. The optimum capitalization structure for an enterprise includes senior securities to the extent that they may safely be issued and bought for investment. With the Company C, on the other hand, we are not convinced regarding the safety and bought for investment part. A bond earning only 1.66 times its interest expenses is typically not seen as safe. The threshold for industrial companies, for instance, is 3, according to Graham. Furthermore, the earnings of the common stock of Company C are even more leveraged, and thus up and down swings in the revenues have an even greater effect percentage-wise on the profits for shareholders. In this case, though, the leverage may frighten some conservative investors, and this will decrease the demand for the stock, and in that, also the price and the PE. So, it's safe to say that the value of Company C wouldn't be a total of $8,000, and probably it could be valued even lower than Company A. We conclude by calling the capitalization of Company A over-conservative, that of B appropriate or suitable, and that of C speculative. It's summary time! The first priority of analyzing an income statement is to understand what the true earnings of the past have been. There are many ways that earnings can be misrepresented. By being aware of these tricks, the intelligent investor can adjust the historical figures to a more correct version. Averages and long records make assumptions about future earnings more reliable. Weed out weak companies by the careful study of balance sheets. Some debt can actually be beneficial to the investor in common stocks, as his invested amount becomes more productive when a reasonable part of the capital is borrowed. In the next video, it's finally time to talk common stocks. And after that, in the last video of this mini-series, we'll discuss senior securities. Cheers! How can you identify individual stocks that are undervalued? How do you make a comparative analysis? And is it possible to time the market? In this third part of my summary of security analysis, written by the legendary father of value investing, Benjamin Graham, these are some of the topics that will be discussed. In the previous videos of this series, I've presented differences between speculation and investing, and talked income statements and balance sheets. They're not really prerequisites, but I strongly recommend that you watch both of my previous videos of this series before continuing here. Back in 1940, when Benjamin Graham and David Dodd released the second edition of Security Analysis, stocks were valued at 12 times their yearly earnings on average. Today, the price of stocks is almost twice as high. But don't let that discourage you. It is still possible to be successful in the markets. Let's learn how. Takeaway number 1. Finding undervalued stocks. The danger of paying the wrong price is almost as great as that of buying the wrong issue. According to Benjamin Graham, there are two different approaches to find undervalued individual issues in the stock market. 1. Using comparative analysis, which we'll get to in the next takeaway. And 2. Scrutinizing corporate reports as they go live. One of the most successful investors implementing strategy 1 was Philip A. Fisher, who was screening about 250 companies before deciding to invest in a single growth stock. The most successful investor implementing strategy 2 is Warren Buffett, who famously reads about 500 pages of annual reports and the likes every day. Whichever strategy you choose to follow, you want to look for discrepancies between the intrinsic value of the company and its price. Mistakes in pricing individual issues are often caused by exaggeration, oversimplification, or neglect. Here are two types of situations when the market typically overestimates the true value of an issue. Increases in dividends. An increase in dividends is, according to Benjamin Graham, a favorable development for the stock. But not so favorable that it's justified for the stock to rise, say, $20 because of an increase from $5 to $6 in dividends. The buyer at the higher price is already paying in advance for 20 years of the extra dividends that he will receive with the new rate. Mergers and spin-offs. Wall Street loves it when there's a lot of action. But to be equally enthusiastic about mergers, as of spin-offs, is kind of hypocritical, as they are each other's exact opposites. You may have heard that 2 plus 2 is said to equal 5 when it comes to mergers. But did you also know that 5 divided by 2 equals to 3? And here are two situations in which the market tends to underestimate values. Litigations. Investors are typically scared off when companies are threatened to end up in lawsuits. But often, the consequences aren't as significant as the drop in price indicates. Financial troubles. Don't buy companies that are likely to fall into financial difficulties. Buy those that already have. If you are going to follow this strategy though, Benjamin Graham advises you to be careful and diversify a lot, since many of the investments will go bust. Takeaway number 2. Comparative analysis. Here, I will illustrate one of the methods of finding undervalued stocks by doing a comparative analysis of the world's 4 largest fashion retailers: Inditex, H&M, Fast Retailing, and The Gap. Remember that figures in these types of comparisons are only useful for wide and obvious disparities. Before we start out, I think a disclaimer is in place. With that out of the way, let's compare these fashion giants with one another. I've chosen to look at the following key ratios. Regarding earning power, I've picked gross margin, operating margin, net margin, return on assets, return on equity, and dividend yield. Gross margin may be extra important to study in the case of retailers, as this reveals the markup that the company gets on average on products sold. We see that Inditex is way better than the others when it comes to margins from sales, and that Inditex, together with Gap, are better at profiting from money in the balance sheet than the others. It's probably a good idea also to look at how these companies have been able to grow their sales. During little less than a decade, we can see that Fast Retailing has outgrown the others, followed by Inditex, H&M, and lastly Gap. If the companies would have stagnated in their growth, I would be more concerned about Fast Retailing paying such a low dividend, but in this case, it seems the excess capital is being put to good use in the business. Regarding financial stability, I've looked at the interest coverage ratio, the quick ratio, and the equity to assets ratio. The interest coverage ratio is a very important metric to consider when investing in bonds or preferred stocks, which we'll get to in the next video. But it's fair to say that all 4 of these companies pass Graham's test by a landslide. Regarding the quick ratio, H&M looks quite weak, but considering the profitability of the company, I wouldn't be too worried. Inditex has the least amount of debt, which isn't just a defensive advantage. The company also has more financial muscles to make a bold offensive move than its competitors by, say, acquiring another company. You also want to see that the executives of a company you invest in have skin in the game, in that they hold shares in the business just like you. The Ortega family of Inditex still holds about 59% of the company. The Persson family of H&M owns 46%, the Yanai family of Fast Retailing holds 44%, and the Fisher family of Gap owns 36%, so they all get a definite pass here. Furthermore, Benjamin Graham suggests that one should look at industry-specific ratios, and for the fashion retailing industry, I'd want to see a low or negative change in inventory valuation compared to the year before, a high inventory turnover, and a lot of online sales. Fast Retailing increased its inventory by 59% from the year before, which is a red flag and requires further research. The inventory turnover of the company is still okay though, so it's a sharp increase but from low levels. Regarding online sales, Gap stands out as the most successful adopter of this new trend. At this point, I'd probably say that Inditex looks like it's the best pick. It's not weak anywhere really, and it's also the strongest company in many aspects. But we're missing something. Oh, the price. I've picked price to earnings, price to equity, and price to sales for comparison. Not too surprisingly, Inditex is one of the most expensive companies. Fast Retailing is even more expensive though, and one would be wise to ask himself, before investing in this company, if the market may be too focused on its current sales trend. Because to me, the company doesn't set itself apart on any other account. Conversely, one would be wise to ask himself if Gap truly deserves to be valued at only 1/6 of Fast Retailing's earnings, or about 2/5 of its other 2 primary competitors. After this quantitative analysis is done, the investor must remember to confirm his beliefs from a qualitative standpoint too. This activity is very time-consuming though, which is why it's great to do a comparative analysis such as this one first, to select specific companies for the time-consuming part. From this comparison, I'd obviously pick H&M to do a deeper analysis. How can one not want to invest in this Swedish crown jewel of a company? Let's be serious. If I had to pick here, I'd investigate Inditex and Gap further for a possible investment. Takeaway number 3. Investing in stocks is the search for weakness. Investing in stocks will always be a bet on the future, but as Benjamin Graham expresses it, the analyst must take possible future changes into account, but his primary aim is not so much to profit from them as to guard against them. He suggests that you should find individual stocks that are attractive based on what they've already proven, not what they might prove in the future. Imagine yourself buying a used car at the price of, say, $1,000. If the car does what a car is supposed to do for a couple of more years, this will turn out to be a bargain. Now, you just got to protect yourself from the downside. Here are some red flags to look for when investing in stocks that may spell trouble for the future. Questionable accounting policies. I've said it before, but I'll say it again. You cannot make a quantitative deduction to allow for an unscrupulous management. The only way to deal with such situations is to avoid them. Financial trouble is lurking. A rapidly increasing inventory, weak earning power in combination with lots of current liabilities, rapidly increasing debts, etc., etc., are all examples of this. New competition. When investing in consumer-oriented companies, this can be quite obvious sometimes. In 2012, I invested in a Swedish online casino and betting company named Betsson, and about 2 years later, the only thing you saw when watching commercials on Swedish television was online casinos. This was terrible news for my investment, which I eventually decided to cut loose. A deteriorating management. If you forgot about Warren Buffett's rule to only buy stocks in businesses that are so wonderful an idiot can run them, beware of deteriorating management. Earnings with an upper limit. At times, companies have severely limited expansion opportunities. It can be because of market limitations or because of regulations from authorities. But whichever the case, avoid such stocks. If you are going to have a limited upside, you might as well invest in bonds instead, which we'll get to in the next video. Convertibles and stock options. This can be quite subtle, but beware of companies that have issued a lot of convertible securities and stock options. If the company does well and its total value increases, which is the only reason you'd invest in a stock to begin with, right? These securities will be converted into common stocks and dilute your returns. Takeaway number 4. Buy stocks that are valued below net current assets. Let's return to the balance sheet to look at a specific method for identifying undervalued stocks. Benjamin Graham is famous for searching for companies valued below their net current assets, so-called net stocks. You get the net current assets of a company by taking current assets and removing all liabilities. Essentially, if a company is valued lower than this, it can be liquidated for more money than what you pay for it. The most common objection against buying a net stock is that it may continue to lose money, because, well, typically they do lose money, until the intrinsic value of the company is lower than the price that the investor paid. You see, managers aren't always fond of the idea of liquidating the company, as it means that they are definitely going to lose their jobs. On the other hand, there are plenty of positive things that can happen, that can change the situation in the opposite direction. Earnings can increase, perhaps as a result of the company itself improving, or by an improvement in general of the industry. A competitor may decide to buy the company, and the managers may decide that liquidating the company is the best decision after all. To find net stocks is typically quite uncommon though during normal financial conditions. In the midst of the bear market of 1938, Benjamin Graham noted that about 20% of all industrial companies had, at some point during the year, been valued below their net current assets. When I looked at data from 2018, on the other hand, I found that only 1.5% fulfilled this criteria. Takeaway number 5. Timing the market. Is it possible to hit the ups and downs of the market with any reasonable accuracy? The following discussion won't give you an exhaustive answer to this question, but it will reveal how successful 5 different strategies investing in the S&P 500 index would have been if they were applied during the last 50 years. Benjamin Graham and David Dodd discard any strategies of timing the market that aren't directly associated with fundamental values. So for this comparison, none of these strategies will be based solely on price indicators, such as, for instance, a swing trading strategy may suggest. Here are the conditions. The primary thing you need to remember is that the 5 investors implementing these strategies get an additional inflation-adjusted $10,000 each year. This is money that they've managed to save, earmarked for investing. Here's that disclaimer again. Let's meet our 5 investors. All-in Anthony is the guy who simply invests everything in the stock market as soon as he gets a chance to, which, in our simplified example, is on January the 1st each year. Next up is Earnings Edward, who keeps some cash on the side if the average PE ratios of the companies in the S&P 500 index are high compared to the last 10 years. Sales Sophie acts in a similar way, but she looks at the price-to-sales ratio instead of the price-to-earnings. Bond Betty uses a variation of the method that Graham suggests in this book. She invests in stocks only when the S&P 500 PE ratio is favorable compared to the yield of a 10-year US governmental bond. Finally, we have 50-50 Francis, who applies a strategy suggested in The Intelligent Investor. He tries to stay in 50% stocks and 50% bonds. If stocks have gone down, he will buy more of them to restore the equilibrium, and he will do the opposite if stocks have appreciated a lot in value. 1969 to 1979. Here are the results of these strategies during the first decade. At this point, the race is quite tight, and even though you can barely see him, Anthony is lurking there somewhere, and you can bet that he's all in it to win it. 1979 to 1989. Truly, this was a great time to own stocks. That's why many refer to this period as the Roaring 80s. And none of the investors as much as flinched during the Black Monday, apparently. 1989 to 1999. At the end of this decade, we're in full dot-com bull market mode. And it doesn't come as a surprise, really, that All-in Anthony is starting to create a gap between himself and the others. But can he sustain it? 1999 to 2009. To speak of these prices as representing investment values, or the appraisal of investors, is to do violence either to the English language or to common sense. Or both. Yep, this was the end of the dot-com bubble. Unfortunately, all the investing strategies took a hit in both the burst of the dot-com bubble and during the financial crisis. Some more than others, though. At the end of the decade, All-in Anthony is still in the lead. But it's no wonder that investors refer to this period as the lost decade. 2009 to 2019. And the winner is... All-in Anthony. In terms of yearly returns, his strategy was able to generate, on average, about 1.5% more than 50-50 Francis, and 0.5% more than the others. Over the course of 50 years, as you can see, this results in quite a significant difference in portfolio values. Strategies of this sort aren't without their flaws, unfortunately, as the future may not look exactly like the past, and because the methods require a considerable amount of human fortitude to stick with. Time for a summary. Use a comparative analysis or scrutinize individual company reports to find undervalued stocks. When doing a comparative analysis, remember that only obvious disparities matter, and that it's mostly a tool to quickly reduce the number of companies considered for investment. The future is primarily something to guard yourself against. Weed out weak companies. Stocks valued lower than net current assets may represent true investment bargains, but you'll typically only find them during distressed financial conditions. It's difficult to time the market. An all-in dollar cost averaging strategy seems really tough to beat. The next time, we will look at senior securities. And I know what you're thinking. The next time, we will look at senior securities. There's no way I'll be watching that. Bonds? I'll get a better return stuffing that money under a mattress. Yes, bond yields are historically low. But there are some special cases that are still interesting. Cheers! So, this is the fourth and final part of this series. Endings of series haven't really lived up to the expectations of the audience as of late, but I hope this one will be different. In the first video, we talked about 3 different categories of securities: fixed value investments, senior securities with speculative features, and common stocks. We've covered the last group of securities already, but now we'll get to the first 2. Let's start with fixed value investments. Takeaway number 1. The selection of fixed value investments. Corporate bonds. Investments in fixed value senior securities involves issues where changes in market price can be said to hold only a minor importance, at least for the upside, of the investment. The investor's primary interest in such securities is that of creating a safe and reliable source of passive income. Therefore, it must be limited to high-grade securities only. Bonds are essentially a loan issued against a fixed interest rate. The interest rate, or the yield, is typically paid out once or twice a year in the form of a coupon, and depends on the quality of the company and the time to maturity. In other words, when the loan is expected to be paid back. For instance, McDonald's recently released 2 new issues, maturing in 2026 and in 2034, and yielding 0.89% and 2.87% respectively, while Sanofi, a major drug manufacturer with a better credit rating than McDonald's, recently released an issue maturing in 2034 as well, but yielding only 1.23%. As stated in video number 1, bonds have an unqualified right to fixed interest payments, an unqualified right to the repayment of the loan, or principal amount, but no other participation right in neither assets nor profits. Here are 4 principles in selecting fixed value bonds. 1. Safety is measured by the company's ability to meet its obligations. When buying bonds for fixed value investments, all you should care about is earning power. Some people would argue that if a company goes bankrupt, bondholders have a priority to the assets, so it would make sense to consider those as well. But Benjamin Graham argues that the primary aim of the bond buyer must be to avoid trouble and not to protect himself in the event of trouble. 2. Evaluate under depressive conditions. As security is of the highest importance when doing fixed value investing, it does make sense to measure earning power under difficult conditions. So today, you'd probably want to go back to the financial crisis to see how the company you're thinking about buying bonds from performed during 2008 to 2009. 3. Coupon rates cannot compensate for deficient safety. The investor cannot afford to expose himself to even a small risk of losing his principal at, say, $1,000 in return for an extra, say, $50 of income from coupons. The whole premise of fixed value investing is that you shouldn't have to rely on the insecurities of the future. Because if you do, you must be able to gain as a reward for being right, as you will always be penalized for being wrong. And investing in bonds, near par value, doesn't give you that. They don't appreciate in value unless the interest rates experience a major change, and no matter what, they will still be worth the par value at maturity. 4. Use exclusion and specific quantitative tests. Instead of finding the bonds with the highest potential yields and then look for safety, one must do the reverse when investing for fixed value. First, exclude all issues of questionable security. Use a minimum standard. Then work yourself upwards regarding yields. When calculating the interest coverage, for interest expenses you must use all obligations that are equivalent to bond interest. And thus, you may also need to include expenses such as rentals and guarantees. And yes, there are many other factors that could be considered to assure the safety of a corporate bond, outside of interest coverage and market cap to debt. But if you want to add extra safety, you might as well increase your minimum requirements on these 2 points, instead of complicating things by adding additional statistics. Sometimes less is more. As a side note, governmental-backed debt is much easier for the individual investor to acquire than individual corporate bonds. And there are other alternatives to fixed value bonds as well, such as paying off your mortgage. Takeaway number 2. The selection of fixed value investments. Preferred stocks. Preferred stocks are very similar to bonds when they are bought as fixed value investments. Typically, preferred stocks don't have a specific date when they mature though, but companies may choose to buy back the issues because of changes in interest rates. A major difference between bonds and preferred stocks though is that preferred stocks don't have to be paid anything at all, unless the common shareholders receive something too. Benjamin Graham and David Dodd are therefore very skeptical to investments in preferred stocks for fixed value purposes. That the typical preferred stock represents an unattractive form of investment contract is hardly open to question. On the one hand, its principal value and income return are both limited. On the other hand, the owner has no fixed enforceable claim to payment of either principal or income. The 4 guidelines mentioned previously for investing in bonds for fixed value purposes apply to preferred stocks too. But because of their lack of enforceable claims, the minimum standards must be erased to the following. Furthermore, the interest coverage ratio must include not only the payments on bonds, but also that on preferred stocks. In 1932, only 5% of the listed preferred stocks met the criteria. Benjamin Graham concludes that not only are preferred stocks of the fixed value type exceptional, but they must also be called anomalies or even mistakes, as they are preferred stocks that should have been issued as bonds. Because whenever the business issuing the preferred stock derives a benefit from its right to withhold the dividend payments, the owner does not have a fixed value investment. And, on the other hand, whenever the issue is of high grade and suspension of dividends are very unlikely, the issuer should have used bonds instead, as they are typically priced relatively higher. Takeaway number 3. Senior securities of inadequate safety. The previously mentioned bonds of Sanofi, with a yield of 1.23% until maturing in 2034, is regarded as a safe investment by the market. Compare this to a bond from Bed Bath & Beyond, a retail store, which also matures in 2034 but yields 7.68% instead. The difference is quite major. Does this mean that there's a 6.45% free lunch? No, of course not. The market thinks about the bond of Bed Bath & Beyond as one of inadequate safety, and therefore the yield is higher. Such speculative bonds and preferred stocks should be viewed from the common stock direction. The evaluation of the issuing company, before deciding to make a purchase, should be pretty much the same. Furthermore, it's not enough that the coupon rate is higher than that of a high-grade senior security. The security must also be priced at 70% of its par value, or less. Why? Because, as previously mentioned, when you rely on insecurities of the future, there must be a reward for being right, as you will always be penalized for being wrong. The reward, in this case, represents the possibility that the issue can appreciate almost 50% in value, to be priced at par, if the company does well. Also, beware. An investment in a senior security of this speculative sort should never be made if it requires the assumption that the common stock is also priced too low at the time. Because if the investor is correct about his judgment of the common stock, it would be more profitable to buy the share instead of the speculative senior security. And if he's wrong, the price of the senior security will probably drop too. There is an exception to this rule, which we'll get to in the final takeaway. Takeaway number 4. Senior securities with speculative privileges. Some senior securities come with speculative privileges, which makes it so that we no longer can classify them in the category of fixed income investments. There are primarily 3 different types of such securities. Convertibles. The owner of the security has the right to exchange his senior security for common stock on specific terms. Participation. Not only does the owner have a right to interest payments, but he has the right to additional income too, usually in proportion to the dividends paid on the common stock. Subscription. The holder of a senior security of this sort has the right to purchase common stocks on predefined terms. The attractiveness of the form of these securities cannot be overstated. They possess a combination of maximum safety and a possibility of unlimited appreciation in value at the same time. However, the investor in a security of this type must decide if he's buying because of the attractiveness from a fixed value investment perspective or because of the speculative participation in the common stock. When investing from the fixed value investment perspective, Benjamin Graham argues that the terms of the agreement are more important than selecting the company with the common stock most likely to increase in value. Not because it has a higher impact, but because it can be dealt with more definitely. The terms should be evaluated from 3 perspectives. The extent of profit sharing to investment. The higher, the better. For example, Company A has bonds with a warrant, a subscription privilege, attached to them, stating that for every $10 in bonds, $20 in stocks can be bought. Company B has bonds that allow for the purchase of only $10 of common stock. Should the stocks of the companies appreciate in value, you want to be able to buy as much as possible, and therefore the bond of Company A is preferable to the bond of Company B. The closeness to realizable profit. The closer, the better. For example, Company A has bonds convertible into common stock at $10. The current price of the stock of Company A is $9. Company B has bonds that are convertible at $10 too, but the current price of its stock is $8. Therefore, the bond of Company A is preferable, as its stock must increase only about 11% before the convertible is profitable, while the stock of Company B must increase 25% for the privilege of its bond to be profitable. The duration of the privilege. The longer, the better. Say that Company A has bonds that can be converted for the next 20 years, while Company B has bonds that can only be converted for the next 5. Everything else equal, you'd prefer the bond of Company A, as in this situation you have the option to wait much longer for the privilege to become profitable. Takeaway number 5. Switching. When the price of a common stock and a convertible issue are exactly equivalent on an exchange basis, the two issues are said to be selling at parity. On the other hand, when the price of the senior security is above the common stock, it's said to sell at a premium. And lastly, if it's priced lower, it's called discount. When a common stock is hyped up due to trendiness or similar, there's a considerable amount of speculative demand for the stock. And at times, this causes the convertible senior security to be priced near parity or even at a discount. Finally, we've actually found a situation in which a definite mathematical conclusion can be arrived at in the field of security analysis. Here's an example from 1936, which Benjamin Graham gives in the book. Paramount Pictures Corporation had issued a preferred share with $6 in dividend that at any time was convertible into 7 common shares. At a certain point, the preferred stock was selling at $113 against almost $16 for the common. So, just the speculative privilege of the preferred share was worth $112 at the time. In addition, the preferred share had $12 in accumulated dividend, which had to be paid before the common stock could receive anything. Clearly, if the common stock was worth $16, the preferred share should be priced at no less than $124, so the owner of a common share in Paramount Pictures Corporation should definitely have switched into the preferred one in this instance. Such opportunities are rare, for sure, and they're probably even more uncommon these days than in Graham's time. But in times of turmoil, they may present themselves again. And who will profit from them? Only the intelligent investor and the rigorous security analyst. Bonds of investment grade can be found by insisting that minimum quantitative standards should be met under depressed circumstances. Preferred shares are inferior to bonds as fixed value investments in their form, but you can still find such issues. You do it by increasing your quantitative threshold. Senior securities of inadequate safety should meet the same requirements as when investing in common stocks, and in addition, they must be priced at least 30% lower than par. The attractiveness of senior securities with participation rights should primarily be evaluated from a terms perspective, and the investor wants to see high profit sharing to investment, a price close to a realizable profit, and a long duration. In times of market turmoil, mathematically demonstrable evidence sometimes presents itself, which allows the investor to switch from one security to another one with confidence. Even though I covered 20 takeaways in this series, there are many more in the actual book. If you decide to get the book, feel free to use the affiliate link in the description of this video. Big thanks, by the way, to those of you who helped me with my decision anxiety and participated in the poll. Next up is Trading for a Living by Dr. Alex Elder. I hope to see you then.